How much should your asset allocation, your risk tolerance with your investments change when you retire? What if I said it shouldn't? I'll explain that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Arguably the most important, the single most important financial decision that you'll make in your life is your asset allocation. That's right, how you choose to invest your hard-earned savings. And then not only how you choose to invest it, but will you stick with it in good times and in bad. That determines the amount of compounding that you can expect off of your investments, allowing the savings that you are accumulating, allowing that to grow, and provide a big return for you over time, or a more meager return and have slower growth. This decision is significant. Now, I would argue maybe second most important or just as important is how much are you saving, right? Even the best performing investment, if you're only saving $100 a month and you really need to be saving $1,000 a month or $1,500 a month, there's no real amount of saving or investment outperformance that can make up for that gap. So yin and yang here. But we all know, it's sort of common knowledge that when you're young, you should be more aggressive. Your risk tolerance should be more aggressive, and maybe you shouldn't be speculative, but you should be aggressive, having most of that asset allocation in growth-oriented investments, the stock market. And when you are older, you should be more conservative or less aggressive. Maybe that risk tolerance still has some stocks, but a lot more bonds or less stocks, if you will. That's sort of common knowledge. So then the question is, okay, how you apply that then is that, well, during my career, I'm aggressive. And when I retire, I make this big shift with my investment, my asset allocation, and all of a sudden start taking less risk then. Is that the proper thing to do? Well, we so often see this misapplied, where people think that, yes, during my career, I should be taking a lot of risk. And then as soon as I retire, all of that money needs to be low risk. I really don't want to stomach any ups and downs because I need that money. And therefore, they think of it as, well, while I'm working, this is long-term money. But as soon as I retire, it's now all short-term money. And that lends itself to making a pretty big investment mistake, financial mistake, and that is this barbell approach. I'm either all risk or I'm none at all. And this can really wreak havoc on your overall long-term ability to build wealth, your financial plan, if you will, because this everything being aggressive throughout my career, as you get closer to retirement, if you see a big downturn in the market, even if you're not at retirement, that can cause you to say, I'm not going to be able to retire with these sorts of losses. And you make a big shift early and go from, I was really aggressive to now very conservative. But also this risk of being all risk and then no risk can mean that your retirement, which could be decades long, you can have very, very little growth and really take you off track and off plan with your finances. So what if I told you that when you retire, you shouldn't make any big changes with your asset allocation. In fact, you should be making gradual adjustments along the way, and that your retirement from an investment standpoint is just another step that you take in your financial journey, that it shouldn't be this great reset or this significant reset. It should just be another step. That's right, all throughout your career, at retirement and through retirement, you should take the appropriate level of risk in your investments that allows you to do two things. One, sleep at night. That's right, and not have to worry about your finances. You should be taking the right level of risk to be able to sleep at night. Some of you, in order to sleep at night, you need to make sure that you're getting all of the goodness that the market provides. You need to be taking a lot of risk in order for you to have peace with your investments so that your investments appreciate as the market does. Others of you, knowing that the market has volatility and has risk, in order for you to sleep well at night, you can't stomach a lot of variation in your investments. And therefore, it wouldn't have you sleep well at night if you had a lot of dollars in the stock market. You need to know who you are, which type of investor you are, and your asset allocation, your risk tolerance needs to be set appropriately so you can have peace and sleep at night. But then the second is your investment asset allocation or risk tolerance needs to be aligned with your financial goals. Because if you are that investor that, yes, I'm a long-term investor, but I get really spooked when the market does normal market things, which is, a decline of 20%. No one likes it, but that's a feature of the markets, not a bug. It's a feature. On average, going back 40 years, the stock market from a high point to a low point within the year averages about a 14% decline each year. Does it happen every single year? No. But when you spread those odds out and those occurrences out, yeah, we should be prepared at any time for a 14% or more decline. If that really concerns you, then fine, and then that's okay. Then your asset allocation should be a little bit more conservative. But your financial plan and your retirement plan should be built on achieving those more conservative investment results as well. So your asset allocation, your risk tolerance, your investment strategy throughout your career, at retirement and through retirement should allow you to have peace and sleep easy at night and be consistent with what you expect in your financial plan. And it's totally appropriate while you're younger to, I sleep easier at night, taking a lot of risk. And then when you're in your 60s or in retirement, I actually don't want to take that same level of risk. I'll sleep easier at night if I'm a little bit more conservative. That's okay. That is appropriate. And for many people, that is what happens. But those are the guardrails. So instead of this big adjustment and reset with your asset allocation at the moment you retire, instead, as you approach retirement, you should be shifting your investments and be guided on how you should invest them based on their time horizon. And so many people think that when they retire, all of their assets, they're short term, all of their assets, when in fact, that those assets that you've saved up and accumulated sort of need to be tilted on their side, and the dollars that you're going to use in the short term, let's say the next 2 to 3 years, those should be invested in short-term investments. The dollars that you're going to use immediately after that, so the 5 to 7 years after that, those should be in intermediate-term investments. But the dollars that you're not going to touch for the next 10 or for at least 10 years out and beyond, those should still be in higher risk, right? Because your time horizon is such that you can still stomach the ups and downs with those dollars, and you need to be able to do so that those dollars can fight inflation, right? Which is over time going to be that sort of silent killer or that drain on your portfolio, your purchasing power. So as you approach retirement, not at retirement, but as you approach retirement, you need to be recalibrating and saying, okay, are any of these dollars going to be used in the short term? Do I think I'll withdraw any of these dollars within the next 2 to 3 years? No, retirement's still 5 years away. Okay, but for years, for the 7 years after that, any of these dollars that I expect to use, I would. And you can quantify that through planning. You can back into, here's how much we're spending, here's how much I expect to draw from Social Security, here are my other income sources, and therefore, this is how much I expect to draw from my portfolio. So typically when you're about 5 to 7 years out from retirement, that's when you start shifting some of your dollars into intermediate term or lower risk investments. Not a lot, but some of them, okay? And then as you get closer and closer to retirement, you're building up that nest egg or that portion of your asset allocation that are short-term dollars and are invested in short-term type instruments. And therefore, when you retire, it's just simply implementing these slow, steady, intentional progress or adjustments that you've been making through the final 5-10 years of your career. We call that the personal pension plan. This is how many large pension funds are able to mathematically invest for the long term while paying out pension checks to hundreds, if not thousands, of individuals in the short term, having the dollars that are going to be drawn in the short term in low risk, very predictable investments that, have lower return. The dollars that are going to be needed in 3 to 7 years are invested intermediate term. There's still a little bit of growth potential, but if there's a big downdraft in the market, they're not as susceptible to those. But then the dollars that are more than 10 years out or longer term are still invested for the long term. And That's the approach that you should be implementing during that final stage of your career and have in place already by the time you retire. So here's a question. Does your investment strategy right now that you're taking, does it, one, allow you to sleep at night? And two, is it consistent with your financial plan and what your financial plan needs? Is it consistent with that personal pension plan strategy that I laid out? Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with KWiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.